Thank you for what has been an amazing conference thus far. My name is Reid. I'm a Senior Vice President at RockCreek. We're a $16 billion asset management firm. I focus on venture capital fund commitments, and I'm excited and proud to be joined by three great LPs, all based in the DC area, all very much plugged into the Black VC ecosystem, and all three different kinds of LPs. So I'll start with Sharkestein from interim CIO at USMF. He is on his home turf. We have Keith Stone, apologies. Keith is a partner and portfolio manager at Brown Advisory. And then Renata Aráuz-DeStefano, she is an investor at Pivotal Ventures. So I'm going to pass it off to each one of you guys to quickly introduce yourself, tell us a little bit more about the firms that you guys are working at, and how venture capital kind of works and how it fits into your broader investment thesis.
Sharkestein with the University System of Maryland Foundation. University College Park clearly is one of those that are in the system. We also manage assets for smaller college foundations in Maryland. Certainly excited to be here. Multi-billion-dollar fund. I'm one of a team of about 6 individuals who manage those assets. And how does venture capital fit in? Clearly, it's a growth engine of the portfolio. I think our portfolio is a little bit more unique in comparison to others, in that we have a lot less in venture capital than our peers. We're certainly more kind of credit focused and buyout focused than venture capital, but that's something that's growing in our portfolio. And I'm happy to talk more about that later.
Keith?
So, can you hear me? Yeah. Keith Stone, I'm at Brown Advisory. So Brown Advisory is based in Baltimore, investment management firm. There's 2 sides to our business. One is institutional, where we manage mutual funds in-house, so public equities and fixed income. The other side is kind of high net worth wealth management, as well as some OCIO clients and endowments and foundations. So I sit on our private equity team. We invest across all asset classes, but I spend all my time on venture. Excited to be here. I think we've committed around $5 billion over a 20-year period, so pretty active in the space. That's across all private equity. But yeah, excited to be here.
Hi, great to be here as well. My name's Renata. I'm with Melinda French Gates' incubation and investment firm, Pivotal Ventures. We work across policy, philanthropy, and venture. I sit on the venture team, and for us, our focus is on women-led funds, particularly. We invest as an LP. We also do some direct investing, and I would say it's part of our overall strategy that centers women. And when we think about women in venture, as Himalaya mentioned, for example, like there are not that many of us, especially women of color. So it's part of our overall mandate and our goal of expanding women's power and influence here in the US. So in venture, that means getting more capital into the hands of women check writers with the hopes that that will trickle down and result in more diverse groups having access and control of capital.
Awesome, thanks for that. So let's start macro. Obviously, the overall market environment has changed pretty significantly over the last 12 to 18 months. Shark, starting with you, how has this landscape really changed the way that you guys think about asset allocation as a whole and risk kind of allocation?
Yeah, thank you for the question. I think sometimes what happens is that, especially people who sit in these seats, they forget about the macro and that's going to inform how we make our allocation decisions. So it's not necessarily something that's an excuse. It actually is something that, as we think about the forward calendar, we think about how we're going to allocate capital, it's something that's important. So what happened last year? We talk about being a very difficult environment. Last year, S&P down 18. You had the Barclays Agg down 13. You had essentially correlations going to 1, which is, as an investor, is one of the worst things. There's no place really to hide. Fiscal year 21, if you had a lot of venture capital in your portfolio, you were high flying. Your fiscal year was up 40, 50, 60%. If you didn't have any, you lagged. The exact reverse happened in fiscal year 22 and calendar year 22, such that you saw a downturn. What does that mean? Everyone here knows about the denominator effect. You look like you over-allocated. So this year, coming into the year, it was, well, we can't allocate as much capital as we thought we could. And on top of that, we don't know if we have necessarily the amount of liquidity that we thought that we had in the beginning. So to that end, a lot of people are looking at, one, what's my liquidity? Because in times of crisis, liquidity is the most important thing. And then two is, well, what are my alternatives now? In a zero rate environment, I didn't have any alternatives. Now you actually have alternatives. If you are looking at a private credit fund and you can get double digits unlevered, I mean, that's something that you didn't have before. Cash isn't trash anymore, and your bond portfolio might actually be defensive. And if you're a fund that's mandated to return 5%, well, do you need all of that growth or not? And so it's become something where it's kind of two-tiered. One is in this high rate environment, you're nervous on your sponsor-backed firms, will they be able to service their debt, they'll be able to service their debt. On the other end, you have more opportunities. So to that end, it's a long way of saying that a lot of my peers are looking at growth in the portfolio, and it's widened versus just leaning out on the risk curve. Things that were risky are actually providing a little bit more yield, which means that the priority may not be going that far out in the risk curve, which could have an impact on venture capital. And on top of that, the raise environment's a little bit different than it was in 2021.
Just a little bit.
A little bit.
So Keith and Renata, just to kind of dive in a bit deeper, VC has been massively, changed in this market environment. So how are you guys thinking about VC deployment over the next, let's say, 6 to 12 months?
I would say our strategy is a bit different. Outside of the philanthropic portfolio, the traditional grant making, we're 100% privates focused, only venture. So our mandate is, we're full speed ahead with investing. We target 5 to 8 investments on the fund side per year, and we just got approvals for our 4th and 5th 2 weeks ago. So we're right on target, hoping to make 1 or 2 more this year, but recognizing that that's somewhat of a privileged position for me to be in on this team, that we don't have exposure to public markets, we're not doing real estate, et cetera. So we're full speed ahead.
Yeah, I think on our side, we don't manage a whole portfolio, so we only invest the capital that we have, which is all private focused. But we're certainly only getting capital from our clients, and so we're feeling kind of the impacts a little bit from a more difficult fundraising environment. When we go out to raise from our clients, we raise fund to funds. And I think there's just less interest in demand for venture than there has been the last couple of years, which is just a reality of things. So I think for us, we'll still be active. My guess is we might finish the year with fewer managers probably than we started. That doesn't mean we're not making new commitments, but it does mean that particularly, I think we probably, like a lot of venture funds, I think a lot of LPs look back at 2020, 2021, and you kind of reset and reevaluate. Did we get a little bit ahead of ourselves on some stuff? Did we do some things we maybe don't feel great about? And I think you pull back there. And so for us, we're spending a lot of time looking at particularly the very large, kind of multi-stage, very quickly raised funds, and I think kind of re-underwriting a lot of our portfolio there. So we'll be active, but certainly won't be at the scale it was the last 2 years.
Yeah. No, it makes a lot of sense, and I'm sure a lot of the GPs in the room have heard very kind of similar stories, in terms of how LPs are thinking about this market environment, staying in the game, but maybe doing a little bit less. So directing this question again to you guys, to Keith and Renata, I think, in terms of the factors that you guys are looking at as you're conducting diligence, what are the kind of big factors big buckets that you guys try to kind of fill, big questions that you try to answer as you're trying to get to a yes in your portfolio?
I would say we start with what I like to call product market fit. Is this the right GP to raise and invest out of this fund? And that includes everything from expertise. Have they operated in this sector before? Have they invested in this sector before? How are they prepared to add value to these portfolio companies? Number 2, Nasir just touched on this. What's the vision? When it's a Fund 1, we're asking about what Fund 3 looks like. If it's a Fund 3, we're asking about what Fund 5 looks like. We're looking for GPs who are building a firm rather than a fund. And we also want to be long-term partners. So we're in it for the long haul, and we want to understand that vision. And then diversity and intentionality around diversity is really important to us. So that's within the team that they're hiring and also the portfolio of entrepreneurs that they're putting together. And lastly, I think for a lot of times it's like an us thing and not a you thing with the GPs because we're always looking at our portfolio and diversifying and differentiating. So we're looking at a fund comparing to who is already in our portfolio and seeing if that's, exposing us to a new sector, different geography, et cetera, and like how it's adding value to our overall portfolio.
Yeah, I don't know. I agree with all that. I would say maybe the only other thing we'd add is at the end of the day, we try not to be too prescriptive around what we're looking for. But I think it's, hopefully we're able to clearly articulate some point of differentiation that we think has, 10-year plus runway. And so that could be sector, it could be stage, it could be geography, it could be a number of different things. But what is it that we can point to that we think you do better than anyone else? That also, I think the last point you made is that fits into our existing portfolio is a really important one. So, we might have 12 seed funds. This isn't true, but we might have 12 seed funds and have no interest in adding others. And it's not a reflection on whether or not we think you're great. It's a reflection on where you are with your portfolio and, if you have the room to add or not and what that means for the other managers on your roster. So I think that's a really big part as you're talking to LPs is just trying to get a sense for like where is your portfolio? What are you looking for? What's additive? Because it's not always going to be obvious.
So there are a lot of new VCs in the room, people that are kind of just starting out, raising Fund 1 or kind of just finished out Fund 1, raising Fund 2. I want to touch a little bit on GP-LP communication, and I'll open this up to all three of you guys. What are some of the best characteristics of updates that you receive? How frequently are you receiving those updates to make sure that you're staying in the loop as an LP?
I'll start. I think it's there's probably too frequent communication, and so I don't think you should. I don't know that we need to hear from you every month or every other month necessarily, but I think some of the worst case scenarios is if you go a whole year without communicating with someone, and then in the last cycle that means like you might have had one meeting in 2 years before they raise a fund, and that's just not a great way to build a relationship. So I think. For us, we always love when it's helpful when your quarterly reports like actually have some sort of qualitative information in them versus just a financial statement. That always goes a long way. And then I think trying to have calls and communication. Everyone's different. I tend to like text more than email, so I think text is preferred for me, frankly, versus some other forms of communication. But I think it's really just trying to stay in touch and build relationships and. For us, at the end of the day, every investment we make is very much a relationship-driven investment, and so trying to maximize that, post-investment I think is always good to do.
I think you touch on a great point, which is like ask your LPs their preferred method of communication and frequency, because it can vary. I would say quarterly is probably ideal for us unless you're actively raising, and then we want updates like we're working towards the second close. This is the date. This is the final date. So keep us abreast of that progress. Outside of that, I would say in the quarterly updates, also +1 on like qualitative. We want to see how are you proactively helping your portfolio companies. We want to make sure that you're doing what you said you would do. Surprises in a newsletter or quarterly report are usually not welcome. And also just, I think, particularly in this market, like showing that you're incorporating LP feedback, showing that you're responsive and reactive to the market, not in a haphazard way, but really like thoughtfully approaching that. I think those are things that are all green flags for us.
Yeah, I'd say understanding the governance and the structure of the LP you're trying to engage with, and also their preferred method of communication. If you did text me, that's a guarantee that you won't be in the portfolio, because I wouldn't want that. And then also, when you send emails to the wrong person, so if you send something to the president of our foundation or the head of my IC, like that's also something that is a red flag, in the sense that you don't necessarily understand the kind of governance structure. As far as frequency of communication, I'd say it's more so about who you're having conversations with, more so than the kind of frequency, and making sure that they are meaningful and you're having a connection versus just kind of a touch point. I think that some of the for me, something that resonates is some of the kind of personal stories that I get from especially early founders, where it's something that talks about some of the wins and hurdles that they personally had to go through, and it kind of connects them to the growth that they're seeing. That's something that I think resonates. So making the story a little bit more personal. So just recap, make sure you reach out to the right person, and also make the stories a little bit more personal.
This leads really well into the next question, which are, common missteps that GPs have, whether it be funded GPs that are, coming back for re-ups, or kind of non-funded GPs looking for new capital. Can you guys touch on a few more of those kind of common missteps? What are the kind of instant kind of turnoffs as you're meeting with a number of new funds?
Sure. You mentioned funded GPs. For a funded GP, making the assumption that we're going to do it again, I think that's a big mistake. I can think of a couple that won't be there won't be a re-up, and to that end, we'll be very clear for the reasons why that's the case. But just assuming that once they're on your roster, they're going to stay there, I don't think that's a good strategy. And then I'll just repeat what I said before, just knowing who to communicate with. If you send an email to every single person on the investment team saying, hey, I just want to reach out to you, I think that's a good strategy. If you reach out to me and then you say, hey, I've been trying to get a hold of your analyst and I can't get a hold of them, well, the analyst is the one who's writing up the report. And if all of a sudden I tell them, well, how come you're not doing your job? Well, they're not going to see you favorably. And so that has a direct impact. And I've seen that many a times before. So I would say that making sure that you understand the, not necessarily chain of command, but just the inner workings of it. And I'd say those are kind of two key pieces of advice.
I would echo everything you've shared. We sometimes have GPs who are like going to our principal and saying, we've been having trouble getting on the calendar of the investments team. And we're like, what are you doing? That's not how to get on our calendar. And I also like what you were saying earlier about like being transactional. I think GPs who initiate conversations thinking about the long term, thinking about this is the start of a relationship, really stand out from those that are just like checking a box and being very transactional in their approach.
Yeah, I don't know that I have anything to add.
Got it. That's perfect. We mentioned re-ups. This has obviously been a very tough year. How are you guys thinking about, whether it's this year or kind of in prior years, how do you guys think about prioritizing re-ups versus balancing, looking at new opportunities, sourcing new opportunities, and potentially funding new opportunities?
We try to prioritize re-ups. We actually spent this first quarter pencils down and getting 3 re-ups done. We wanted to be part of the first close. We thought it was really important as an existing LP to demonstrate that commitment. And we're still taking calls with new GPs and new fund managers, but communicating, we'll probably not be able to invest until Q2 or Q3, and that's what we've done. So we got the 3 out of the way in Q1, and just in Q2 we had 2 new commitments to new funds.
Yeah, I think so our portfolio has been more in a growth mode probably over the last 5 years, where we've added more managers as we've kind of built up to where we wanted to be. And so I think now a lot more emphasis on re-ups. I think we will continue to do some new things. It's a really high bar, but I think the re-ups, like particularly for the relationships that have done where they do what they say they're going to do, you're happy with the performance, making sure that you can be supportive of those first and foremost is kind of our priority. And then we'll selectively do some new things. And again, it's probably going to be, where is there something that's really additive to the exposure we already have, I think is where we'll be more likely to be active.
Yeah, I think that's important, just to dive down into a couple of things there. One key thing, why re-ups are sometimes more attractive. It's not just kind of laziness or anything like that. It's more so of just your kind of resource constraint, and you also have to understand the governance model. The governance model could be different for a re-up commitment versus a new manager. And then also, if you have a finite resource, which is kind of people power on your team, the diligence that's required for a new manager, it has to be a high hurdle, as he alluded to, because then your manager roster now expands versus going to 10 AGMs, now I'm going to 11 or going to 12, and we have to do that. And so to that end, I think that it becomes sometimes a resource constraint, and it seems like an excuse sometimes if I was on your end, but it absolutely is not, to the extent that the governance structure allows. It's an easier path on the re-up side, and from a resource perspective, it just makes life a little bit kind of simpler. So I think I want to just kind of double underline that point.
Oh, fully agree with that. Renata, I want to circle back to something that you said earlier about diversity and inclusion. I want to open it up to all of you guys. What are your expectations around diversity and inclusion within the funds that you guys are investing in or diligencing, and how important are these factors in your decision making?
I would say for us it's an important factor. It's one of many that we consider, but it shows up in all of our intro diligence calls, like the 30-minute call. We look for intentionality. So when it comes to hiring, when it comes to the founders that you're backing, we don't have a diversity mandate. We don't require our funds to be women-focused or BIPOC-focused, but we do track the numbers. In all of our memos, we're showing like X% women founders, X% BIPOC founders, and we're tracking that over time. So we do want to partner with GPs who see the value, know the importance of measuring it, and have a thoughtful approach to building diverse teams and portfolios.
Yeah, so we don't have a mandate either around that. I think it's part of what we look at. I think we tend to, at times, it's a core part of the thesis around some of the investments that we're making, but it's not something where we have a DEI process that we run through kind of every fund that we'll commit to. I think for us, we try to make the best investments, and a lot of times that's black-led funds, a lot of times it's women-led funds, but we don't kind of put parameters around it from an investment perspective. I do think we do have some clients that care very strongly about that, and so we'll surface, I think, stories and data points around that as much as we can, but it's not a mandate.
Just to kind of zoom in a bit more, you guys both mentioned something about why you think it might be important to do this. Diverse and emerging, and I guess women-led managers as well, have been the most hard hit by this VC pullback. But you're all here for a reason. Somewhere and through some means, diverse managers and emerging managers have kind of made it into your portfolio. Why do you think it's so important to kind of look at these managers, continue sourcing these managers, even without a dedicated mandate?
I was at a conference in LA a couple weeks ago, and Roy Swan was speaking from the Ford Foundation, and something he said really resonated with me. He said, the moral case alone about why we should be doing this work often fails, and the business case alone also often fails. And I think at Pivotal, we're trying to make both cases. We think it's the right thing to do. We think it's the equitable thing to do, but we also want to generate meaningful returns, and we want to prove 5-10 years from now that LPs that were not betting on diverse-led funds missed out. So we're hoping to prove that both on the moral case and the business case.
I get Sharkus, you want to go? I'll go.
Yeah, just have intentionality and make the case. I think if you're in the seat, sometimes it's just pretty easy to see what was it like before you got there and what's it like now. It will just show. So I understand is it the moral case or whatever it is. People sometimes just focus on what the results are. Mm-hmm. And sometimes the results speak for themselves. And if there's an ethos and intentionality around it, doesn't necessarily matter if there is a mandate or not.
Yeah, I would agree with all that. And I think it's just, for us, we see it oftentimes as an opportunity. There's just less people focusing on on certain founders, and that means that there's oftentimes a greater potential to have special access. I think I mentioned before, one of the things we look for is like what's a differentiated competitive advantage, and I think that's one of them. And then I think another thing is, we'll see, I think time will tell, but one of the things we talk about a lot internally is the going's just a lot tougher now for all founders. And in many ways, that's normal, particularly for Black founders. And so an ability to navigate a challenging environment with less capital is second nature. For a lot of founders, that hasn't been the case. And so we think there's probably an advantage that comes from some of the challenges of just being less funded. We'll see how that plays out over the next couple of years, but I suspect we'll see the benefits of some of that in our portfolio.
Completely agree with all that. As my last question, and then we'll open it up to the broader group, for the new VCs in the room, what advice would you give for kind of a fund one that's looking to align their structures and their strategy around LP expectations?
So I'll go. I would say be really clear about why you're doing everything you're doing. So I think for us, one of the things that when I first started as an LP, I thought was a little bit silly, but in hindsight, is very obvious and very important. Is if what you put in your deck is not the way you execute your strategy, that's a very obvious red flag. It's very easy to take you off the list if you say, hey, we're going to do 20 investments and we're only going to lead, and then you do small checks and Series C rounds and your seed stage fund or whatever it is. Make sure you can really explain why it is you're doing things. There's plenty of instances, by the way, where that makes sense, and so I think we're not against that. Sometimes it's helpful to do more deals to get your brand out and build your brand. Sometimes it's helpful to just work with some of the logos that again attract other entrepreneurs. So I think there's cases where it makes sense, but just be really clear about why you're doing what you're doing, because as LPs, whether we've invested in some fund ones, but when we don't, we're going to look fund two. We're going to go back and look at our notes, look at our conversations, and see if you've done what you said you were going to do. And that's really, if you haven't, it's hard to get over that.
I think one thing I would say is, the statement "I didn't know" I don't think would necessarily be acceptable, just given the level of talent in this room and your peer group. Almost every question that you have, there's someone in this room that's either already gone through it, has gone through it, and will be willing to help you. So if you are new and you have question marks, it's kind of on you to answer that, to get those filled in. I mean, there's a wealth of people here who've all said and came on this stage to say, I want to help. I'm willing to help. Everyone sitting on the stage, everyone around is essentially saying, you know what, I want to help. So the statement, I didn't know I should do this or put this in my documents, I didn't know that I should have this piece, I don't know that's necessarily going to be acceptable, just given the amount of people and organizations that are out there to try to help you. I mean, we're at the summit, for goodness sake. I mean, there's a lot of resources there, and at some point, the I don't know means that you didn't want to leverage the resources that were right at your fingertips.
I would echo everything that's been said, especially on this last point. We're always happy to talk early, be one of the first LPs, walk through your data room, give advice on what you should add, what we're expecting. We even give feedback on decks, and then we're like, we'll talk in 3 months, 4 months when you're ready to really hit the road. So we're here as a resource. And I would also add, I think this came up earlier, given the market conditions, fund ones that are raising should be really thinking critically about what the minimum viable fund size for their strategy is. Now is not the time to be shooting for some fancy headline. Now is the time to focus on getting a track record. Himalaya talked about being creative with what a track record looks like, getting together SPVs. We even talked to folks who have operating background and help them kind of translate their advising or consulting or operating into what looks more like a track record for a traditional LP. And also really be mindful and responsive to the market, take LP feedback, and the last thing I wanted to add, if you have investments, really be proactive and transparent about the health of those underlying portfolio companies. a lot of times LPs are invested in a company through different funds. So if we see one fund marking them down and you're not, we're going to have questions. So I think over-communicate, be transparent, and yeah, don't hide things about your portfolio.
I'll maybe add a couple things I just thought of. So I think fund models like really important, and a lot of times you'd be surprised how often people don't like have a formal fund model or haven't thought through it. And so just like actually build a fund model for how you're going to deploy this portfolio, have realistic expectations for what potential exits could be, because I think that's something that goes a long way. Another one is I think being able to tell the vision of where you're going to be 5 years down the road or 10 years down the road. It's also surprising how often I know it's early and it's like we'll see where this takes us, but I want to know we're thinking about if we're going to make a commitment, we hope to be investing with you 3 funds from now, 4 funds from now, and so we want to know that you're thinking through what that looks like. And then the third thing, to the extent it's possible, is try to build relationships with other VCs. For us, like references are critical, and when they come from our portfolio, it's even more helpful. And so to the extent you're able to have kind of warm referrals and/or references, I think it goes a long way.
Awesome. And with that, we're going to open it up to the audience. If you guys have any questions, I think there are a couple mics that are over here.
Hey, friends. So my name is Jen Fry. I run a group movement app. So if anyone has any retreats that they need group movement, holler at me. So when we're talking about black VCs, it kind of reminds me of the OJ documentary where they say sometimes they want the black face but not the black voice. And so with that, I'm going to ask you, how do you deploy white people to push forward some of this stuff that you need? Because the reality of the situation is, us as black folks, sometimes when we're in the room, there's only so far we can push without deploying white people to help push forward the things that we need to do. Because sometimes no matter, I have a PhD, sometimes no matter how educated we are, how much money we've raised, it does not matter. So can you give some skills or some tips to younger VCs about how they can deploy white people to push forward the things that we need to get done, even if in reality, we're not gonna get the pat on the back they will, we still need to deploy white folks to get shit done.
Great question. I see no one wants to start. I think that's something we think about regularly. I recently was talking to a Latina GP about how we go to all these events focused on women or focused on diverse managers, and we're talking to the same people. The LPs in this room already believe in the power of investing in black GPs and black founders, but how do we get in those other rooms, right? So something that we try to do is think really strategically about where we're showing up. So yes, we want to come here. Yes, we want to go to Black Venture Summit in Tulsa, but then we also want to go to Milken in LA and be in rooms that are predominantly white, that are predominantly male, to be able to say, hey, did you know this black woman-led fund in our portfolio is performing top quartile, et cetera, to really create allies. So we're trying to show up in both places. One, to source the talent, the black GPs that we want to invest in, but then also to bring along the predominantly white or predominantly male LPs and show them of the value by demonstrating through our performance.
I think maybe another thing is just trying to diversify the LP base. So I think to the extent that we can be helpful in getting people seats at the table, I think that also helps. But I don't know. It's a good question. I don't know that I have a great answer to it.
Yeah, I don't know if I have that much to add other than casting a wide net with the LPs that you are kind of conversing with and chatting with, and then I think as it relates to performance and going from a fund 1 to a fund 2, nothing speaks better than returns and being able to point to those kind of proof points and saying, hey, I am who I am and I have these 5 great investments that are strong performing. I'm expecting this to continue in fund 2.
Thank you all for being here. Carl Leacock, Investment Associate, Revolution in the Ventures arm. So I've been on the team for about a year now, and I've noticed that there's, I think, 3 types of investors. Some that are financially inclined, that have that background and have been an investor for a while. You have some that are killer operators, can actually company build, truly understand what a go-to-market is and like can actually get people to their next phases. And then you have some that are just killer fundraisers that, know everybody and they know all the LPs, et cetera. Let's leave aside that one. When you're evaluating like an emerging manager and, you have one side of the table, one guy that, or woman who, has that investing experience, has been at, great shops, et cetera. But, you have another person that has the operating experience, can actually company build. Like, who are you going with? And what have you kind of seen over the past couple of years of what sort of, skills and criteria that you care about more? Both people reference check the same way, right? Like, all the stuff checks out. Like, what are you going for? I'm curious about that.
I think in this market, like investment experience is at a premium. I think, look, if you look back at the last 2 years, there were some tremendous operators who started funds, and I wish they had some investment background prior to doing that. And so I think for us, like, again, to knowing the LP, like, we got to go in front of our clients and our committee. It's easier to point to today. This person has, investment experience and has done it, and that we can point to. I think that's just an easier conversation. We've done both in our portfolio, so I think I don't have a great answer for you here, other than like I think it comes down to like I think a lot of this is relationship based. I think a lot of it is like a gut feel, for better or worse. And so it's like, what makes you really want to take a bet on someone? And a lot of times it's not your experience, whether that's investing or operating. It's like all the other things that go into it.
Yeah, I'm very excited he said that, actually, that it's not so formulaic. I think that's the honest answer. And then also, if you heard what he says more relationship driven as well. So when he gave the advice of saying, talk with your VC peers, talk with my peers, that sort of validation, which isn't the X's and O's, it's not on the paper, it's, oh, so-and-so's invested as well? Oh, okay. Wait, this analyst likes them? Because the thing is, it's a small community. We know who the good analysts are, as far as on our seat. We know who the good firms are, and we know who's kind of trustworthy. So that peer validation rings more than your X's and O's. And I think that's something that's not a dirty secret or anything, but it's literally what he just said. It's not going to be formulaic, and that's why the kind of relationships matter. And knowing the kind of hub and spokes of who are the drivers of relationships, meaning who's trusted in the ecosystem that you're looking at, whether it's family office, endowments, foundations. Find out who those folks are and then say, oh, okay, I got validation from this individual. They have relationships here. That means that if they sign off on me, that's probably a feather in their cap more so than an extra year of operating experience. I know that doesn't help, but it's the truth.
Yeah, no, I would fully agree, and I would say, it is not formulaic. It is really tough to give a concrete answer to that because it depends is kind of the answer. But to the point on being a relationship business, who you know matters, and being able to convey your message is what matters most. So with that, we're going to wrap up. I want to thank the three amazing panelists for joining me up here today. We will be around if you guys have any further questions.